Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate.
A shot of the stock market is going down this week. Hello there, welcome to the Warren Buffett Notes. Today's question: you won't believe how much impact the situation has on Warren Buffett's top stocks. If you want to know this answer, make sure to watch the video till the end. Today we cover 3 stocks from Warren Buffett's portfolio that are reacting strongly to the current situation in the market: Bank of America, Moodys, and US Bancorp. These 3 stocks are collectively more than 15% of Berkshire Hathaway's total portfolio. And good to know is that Berkshire Hathaway is Bank of America's largest shareholder. They own over 20% of this bank. Last week, the Federal Reserve continued its fight against inflation, raising its benchmark interest rates by 75 basis points. Since March, the central bank has raised interest rates from near 0 to 3.25%. The aggressive rate hikes over the past 6 months created ripple effects across the stock market and the broader economy. For instance, the financial sector as a whole feels the impact of raised interest rates. This sector is one of Warren Buffett's favorites to invest in, with Berkshire Hathaway's portfolio holding stock in various banks, rating agencies, and payment processors. Here's how rising interest rates affect 3 of Warren Buffett's top stocks. The first stock is Bank of America. Buffett's second largest holding is also one of the most interest rate sensitive banks you can find. It's particularly sensitive to changes in interest rates because 40% of its $1.4 trillion in deposits from consumer wealth management clients are in low or no interest checking accounts. In a rising interest rate environment, that's a good thing because the bank can rake in higher interest income on loans, while the interest paid on deposits doesn't increase by as much. In the first half of this year, Bank of America's net interest income, or NII, increased by 18% year-over-year to $24 billion. In its recent filing for June 30th, the bank said a 100 basis point increase in interest rates would cause NII to increase by $5 billion over the next 12 months. Since that regulatory filing, the Federal Reserve has raised rates by 2.25%. Raising rates benefit the bank's net interest margin. However, if rates rise too quickly and negatively affect the economy, the bank could be forced to increase its provision for credit losses while also seeing loan growth slow down. The second one, Moodys. Over the last decade, Moodys benefited from ultra-low interest rates, encouraging companies to issue debt constantly. This year, companies issued bonds at a much slower pace. According to the Securities Industry and Financial Markets Association, or SIFMA, U.S. corporate bond issuance is down over 23% from last year and totals about $1 trillion. As a result, Moody's revenue from this source was down 24% compared with last year. If rates continue rising, Moody's rating business could continue having a hard time. The company will need to lean on its analytics segment, where it helps companies navigate uncertain credit markets, supply chain issues, and a transition to cleaner energy. The analytics segment revenue was up 20% this year, helping Moodys stay resilient amid rising rates. The last one, US Bancorp. The bank focuses purely on traditional banking activities, making loans and taking in deposits. The bank is very selective about its loans, focusing on the highest quality borrowers it can find. For this reason, the bank produces a strong return on equity that has outpaced its banking peers over the last decade. Its focus on traditional banking makes it sensitive to interest rates, and this year the bank's NII has grown by 6.6%. In its June 30th filing, the bank said a 200 basis point increase in interest rates would cause net interest income to increase another 1.54%. Like Bank of America, if rising rates negatively impact the economy, US Bancorp could see a slowdown in loan growth. That is, you can learn from Warren Buffett's portfolio, but you can also definitely become the new Warren Buffett. Yeah, this was it for today. We hope you enjoyed this video. Share this video with a friend if you found it useful. Consider subscribing to the channel for more videos about investing, business, stock market, managing money, building wealth, passive income, and other finance-related content about Warren Buffett.